I didn't ask, what is your form of organization?
LLC.
LLC as a corp or a partnership?
Corporate partnership.
Okay. Is the owner taking a salary?
No.
Payroll. You're an LLC with a partnership election is what it would be called. And so he's getting paid through a draw only. And that's his salary. And that would be the same as a sole proprietorship. And what's your form of organization? Are you a sole proprietorship?
Yes.
Okay. And so you get paid through a draw. Okay.
And that's how we would set it up. They charge accounts as a draw.
Yes, that's right. You are not an employee. They do not consider the owner an employee, therefore you're not paying payroll taxes on yourself, but what do you have to do? Well, on the net profit, you will pay self-employment tax at the end of the year. Right. They're gonna get it one way or the other. It's just the different ways the money's gonna flow through. Paid in capital, that's that original position, that's that original money the owners put in. Retained earnings is the accumulation of earnings from the beginning. That's what that means. And then the net income is always at a point in time for that year or that several months at the point of time that it corresponds to the profit and loss. Any questions? We're going to go through this a little bit again. This is not the last time we're going to talk about this today, but.
This might be too tax-ish, but disregarded entity defined by the IRS when you are filling out that, it seems to me that's just like an individual. I mean, I got that question from a client. They wanted.
What's the
to know
question? Say it again.
The term disregarded entity.
Today?
When they filed to get their EIN, their Federal Employment Identification Number, it wanted to, they were filing as an LLC, and then it asked which type of LLC, and this is just an individual sole
Okay.
entrepreneur.
Right.
But he didn't want to proceed until he understood that term, disregarded entity, which is the first time I had actually heard that term, so I had to look it up. And it's my understanding, it sounds like what you're discussing here, as far as an owner taking a draw
That's right.
would be considered a
Right.
disregarded entity. I don't know
Because
if that works.
what it means is the actual net profit's going to flow, it's a flow-through entity, disregarded entity. It's a flow-through. It's a pass-through for tax purposes. Somebody's going to pay taxes on that net profit. In this particular case, it's the owners. And if there's multiple owners, there's going to be an agreement that says that Bronwyn gets 50%, Naomi gets 50%, and it's going to flow through to them. And then they're going to pay, it's going to flow to their 1040. And then they're going to pay income taxes along with self-employment taxes on that flow through. Yeah, that's kind of how it works. And that's how, this is a great example of how sole proprietors can get in trouble. Because let's say you're going to pay taxes on the whole profit, not just what you pulled out. Because do you have to pull out the whole what the business generates? Absolutely not. But you're going to pay taxes on it. Mm-hmm. So let's say you made $20,000, but you only pulled out 10, because you left 20 in there because you wanted to expand and buy some more stuff, and you're going to need that cash from the sole proprietorship to do that. Well, the reality is she's going to pay taxes on the 20, on the net profit, on the whole amount. And self-employment, income, state, the whole deal, at her marginal tax rate. If she has any other income, that's going to be reported in her 1042. Mm-hmm. So that's how sole proprietors get into trouble, because they don't realize how much taxes is involved, because they're going to pay self-employment, 15.3%. They're going to pay federal, and, depending upon where your federal tax bracket is, but, you get to 15% pretty quickly, right? So now we're at 30%, and state at 6%. So now we're already up to about 36%. That sounds horrible, right? On that 20,000. And the same way with your owners, it's going to flow through like that, and they're going to pay tax on all that in this particular type of entity. How do you avoid that? You have a corporation, not a subchapter S election, and then the tax lies with the corporation. That's how you do it. It's not necessarily a good thing because it is to a point because the tax brackets are a little lower, okay? But any income that the owner takes out of it comes out as a salary or a bonus or whatever you want to call it. But what happens is you pay taxes on that. You pay employment taxes on that too. So that's why sometimes the draw thing can be less taxing is the deal. Okay. Then the balance sheet, what you own, what you owe, and again, the equity, what's left over. In the beginning, the book value was the real value. After day one, it probably may not even reasonable. Okay, so we've got a profit and loss, a balance sheet. If you'll turn to page 8, yes, 8 of your student guide. Let's go through, let's see what we learned. See if we can answer these. Sometimes I read them and think, huh? No. Okay, number 1, a statement of financial position that shows the assets, liabilities, and net worth of the business at a given point in time is a what? Very good, Bromlin got it. Balance sheet, you're right.
I'm sitting beside you.
Okay, you ready?
I'm like blank.
It's a lot. We're gonna pick up speed here. Okay.
That's a balance sheet.
That's a balance sheet. Blank is used to describe an ongoing liability, such as a bank loan.
Debt?
Yes, see, Diana?
Yeah, I got one. Mark that down.
Okay. The amount remaining after deducting all costs of doing business. All costs.
It's either profit or loss.
Yes, you're right. Net profit or net loss. You got it. The summary of events that happen over a set period of time, specifically a summary of the revenues, expenses, and profits or loss of a company that are recognized during an accounting period. What kind of statement is that?
Financial?
It is, but specifically it's not the balance sheet, it's the profit and loss, right?
Oh, another profit and loss.
Yes. The assets less the liabilities, and this is also called net worth. Also called net worth, period, sorry. I don't have my glasses on. So if you take assets and you subtract liabilities, what do you have left?
Not much.
That could be true. What's it called? Oh, come on, Luke, what's it called? Assets minus liabilities is your, no, it's retained earnings is part of it. What did I start out with? Look at your balance sheet. Cheat.
Equity?
Yeah, equity. Aha. Yes, in day one, that's right, day one it was. So always that formula will come back to haunt you next week, by the way. Knowing that formula will really help you. Assets minus liabilities equals net worth or equity. The other side of that formula would be liabilities plus equity equals assets. It's a balance sheet. It's always going to balance. And knowing that it's going to hit both sides of that when you have an entry helps you really get your head around how cash is going to affect your business.
In business school, they always said owner's equity. And it's like one of those things
Right.
you have memorized, but you don't always.
I don't always know what it means. You just have it memorized. I know.
And so like equity without the owner.
That's kind of me in spelling. You know, I did great on spelling tests, 100%, because I memorized the words. I can't spell worth a darn. I'm terrible. I'm a terrible speller. But I can memorize, and then I can't spell the word. Okay, What the business owes, including people and entries such as, wait a minute, wait.
What the business owes, including
Entities such as banks, thank you, I had to put my glasses on here, who supply funds that must be repaid. What the business owes.
a loan,
It's a classification on a balance sheet. It's called the
Liabilities.
yes. You guys are batting 1,000. Okay, sales minus the cost of goods sold. You got it. That's a very important because gross profit and margin there is really what when you're looking to increase the profitability of your business, that cost of goods sold is probably it's going to be your biggest expense for one thing. So learning how you can lower your cost of goods or increase your margin is really key to a lot of cash flow success. Okay, everything that the business owns, including items such as cash, inventory, prepaid expenses, and equipment.
equity,
That's right, assets. It's what they own. You got it. Cost of doing business. What are they called? That's not a bad answer. If they're not a cost of goods sold, we consider them a blank cost and operating cost, right? That's right.
So the question is, what is cost of doing business?
It's
Like,
yeah, we lump anything that isn't a direct cost or a cost of goods sold into operating costs in the simplest of formats in a P&L. There are other, it's a tool. And so sometimes businesses like to pull out maybe sales costs. If it's a big marketing firm, or there's different, but essentially the rest of those are really all operating costs. Cost of purchasing or producing the goods sold during the accounting period.
cost of goods,
Yeah, exactly. Cost of goods. Cost of goods sold. Very good. You guys are good. Okay. We move on. We're going to talk through cash versus accrual only because I bring this in because I think it can be confusing and it greatly affects the complexity and the ability to truly analyze financial statements. So the better job you do here, the better your statements are going to be for financial analysis. Because I could stop right here and just say it's a matching game. The ideal situation is for you to always match your sales to your cost. It's that easy. The problem is it's not easy because of all the different entries that go along with that. So I want to show you the difference between cash and accrual accounting and the basis so that you can better understand and see making sure that you are getting as close as you can probably to that, because the reality is you need to be able to use your statements, and if you're not doing a great job here, it's going to be reflected in your statements. So let's talk about the differences. What happens? Cash accounting, it's easy. Think about it. It's going to record any kind of transaction, any kind of accounting transaction, including a sale or a cost at the time that the cash moves. Now, if you're operating exclusively in a cash world, my argument isn't as great to have you use accrual accounting. Okay? I can give you some ugly scenarios, though, thinking through. If you extend terms to your customers, do you guys extend any terms? Can people charge things?
Occasionally.
Occasionally, okay. Well, good. I hope it's just a case. Yeah, really, it's not easy, because then you have to have someone collecting accounts receivable, and you're going to see that in our case because they do extend terms, and it can get you into trouble. Do you let anyone pay you after you give them your? You do. Wow, you're nice. Because food's kind of tough.
Well, I do, I have a friend who's a customer, and I collect from her like I do my wholesaler, which is once a month.
Okay, very good. Well, she's extending terms. You certainly are. So you want to be able that you're doing a great job of matching that. Okay. Accrual accounting records it at the time of transaction. Okay, so when the actual transaction takes place. So let's walk through just a couple of this very quickly. And Diana, if you don't care, I'll use your business. Okay, so.
White House Farms.
Okay, Bright House Farms. Okay, Bright House Farms sells $100 worth of produce to her wholesaler. And today is March 28th, okay? So,
So it's from the beginning of the month to the end of the month, so I get paid tomorrow, because that's when I make my delivery for the end.
when did you give them the product?
Beginning of the month. It goes from beginning of the month to end of the month.
Is it always in the same month?
Yes, absolutely.
Okay. Let me qualify this. If it's always in the same month, and you pull the statement in the same month only, you're okay. I mean, you don't have a big issue, but let's pretend you don't. Let's pretend that you use the 15th of the month instead. Let's go about, here's the real world, kind of how things work. Let's say Diana sold her eggs to the wholesaler, and she gave them to the wholesaler on the 15th of March. That was $100. She gave them the product, right? Now, she has expenses, right? She has operating expenses that are occurring. What do you got? A few things. What are you expensing during the month? Anything?
Expenses during the month?
Got anything?
Give me a clue. What do you
Utility, maybe you ran an ad, you gas to get to the farmer's market.
Because it's eggs, it's feed,
Feed, which we really call a cost of goods, but I'm going to leave it here for now. Okay, any kind of gas, are you expensing it through the business?
No.
You're taking off your personal. Sometimes that's more lucrative. I get it.
At the same time, I know.
Okay, well.
We're not that far yet.
Okay, well, then that might be an opportunity for you to save some taxes. I'm just saying.
Yeah, I believe you.
Okay. So let's assume, so she's buying feed through the whole month, and her feed people aren't giving her any credit.
Yes, I do that with them
Do you pay them?
once a month,
Oh. Well, let's say
no interest.
no interest. Perfect. Okay. Pays them once a month. So this month, it's not due yet. It's $3.15. She hasn't paid any feed. She hasn't collected any cash. It is now March 30th. This is what her P&L looks like. Yeah. On a cash basis, nothing happened.
Well, that's just with them. I do sell them.
Right.
to people.
I understand.
This is just a cash.
But this is, that's okay. This is just, but on an accrual methodology, what would have happened? An accrual methodology, she would have recorded the $100 sale, the fee that she used to create the $100, maybe it was $15, and she would have had a net profit of $85. That's the matching game, and that's why accrual accounting has value, because it gives you a true picture of really what's going on. And that's what, in your all's case, it would be valuable in making sure that you are matching your revenue with your direct cost of what you've sold. instead of throwing everything in cost of goods, putting it in inventory and then pulling it out when you sell it. I'm sure you're doing that, right? Okay. Because here's what happens in the world. Here's the perfect world. In the perfect world, we get supplies and we pay for them, and the arrow is our timeline. And then we sell an item and we get paid for it. In the perfect world, everything's wonderful. You know, we can pull a statement and everything lines up, you know, because we're doing everything in the same time frame. So we can pull a statement and it's matched and we're all happy and we can read our financial statement and it makes sense. But the real world, unfortunately, happens, and here's what really happens. We get a supply and we get terms, right? Maybe we pay for the supplies later on down the timeline. And then we sell an item and, you know, we let Joe pay us later. And we tell Joe, pay me in 30 days. And when does Joe pay me? If I tell him to pay me in 30 days, yeah, maybe, if we're lucky, right? That's the truth. At least 45, right? Especially if we're not great at, you know, getting Joe to pay, but pays us down the line. So that's the difference.
We threaten with interest.
We threaten and penalties. So in the accrual world, what we do is we account for how we're going to pay for it. In other words, we get the supply, but we record the actual purchase, and the opposite end is we record it in accounts payable. So we expense it because we used it, but we're going to record it that we're going to pay it later. And again, we sell an item, what do? If we extend terms, we're going to record the sale when it happened, and then we're going to post it to an accounts receivable on the flip side, so that's right. That's exactly right. That's it. Okay. We're going to start now with, how am I doing on time? I'm okay, right? Yeah, I am. We're going to start with our case. And on page 10, thank you, is our actual case. Okay, let's read through it together. And then I'm going to ask you, after we read through it together, I'm going to record some comments we have of some things that we learned about it and why, important things that if you were going to help this person analyze what's going on in their business, some things that you feel like would be relative to the analysis, and I will help you with that. But let's go through what's going on. We have Computer Solutions, LLC. They offer computer hardware and software to commercial and institutional clients, so it's almost a B2B. The company rents a 3,000 square foot facility in a local business district that provides both a warehouse and small showroom. The firm deals primarily with large contract accounts that are fulfilled through standardized inventory or just in time for customized products. So they're carrying some inventory, aren't they? The store uses its showroom for demonstrations and portions of its warehouse for a customer service shop to handle basic repairs. Here's where I would say they were doing some service work that they're not really tracking. To handle basic repairs, including hardware diagnostics, software upgrades, and network configurations. Its array of equipment also includes an older cash register, electric cash register system employed in inventory control. So they have an inventory control system, or MIS, and the latest in high quality shelving and display equipment. They were particularly proud of that, and that's why that statement is in there. The business is an LLC, but has elected to be taxed as an S Corp. The business usually prepares monthly and year-end profit and loss statements and balance sheet. The company buys finished products from several manufacturers almost exclusively on account with credit terms that average 2% discount if paid in 10 days and net 30. Their payroll cycle is 15 days. Since the business sells primarily to commercial accounts, the vast majority of sales are made on account, with only about 15% of sales transacted with cash or credit card. The company operates on a receivable term of 45 days. In other words, they are extending 45 days. That might be dangerous, right? The business expects to turn its inventory 7 times per year. The cost of merchandise is the largest of any of the expenses this firm incurs. Very common that the cost of goods sold would be the most expensive and controllable, and where your analysis probably would start. The owner has used borrowing to establish and grow the business in its initial stages. Growth in recent years has outpaced the owner's ability to finance through operations. Increasingly, short-term lines of credit have allowed the business to satisfy customer needs. So that's kind of the background. You're going to help them. You're going to become their consultant. But let's talk through some of the things that's going to affect their financial statements and their analysis. And let's start with the form of organization, because that's going to tell us a couple of things. The form of organization is going to tell us, number one, how the owner gets paid, and number two, how they're taxed, basically. So they are an LLC, right? That tells me something. And they have elected a subchapter S election, which is the exact difference of where you all are. So a subchapter S election means the owner is also on the payroll. Okay? Now, the value of being a subchapter S is you can also take a draw. And if the owner's salary is within reasonable standards of what owners make in this size and type of business, that draw can be without payroll taxes. There might be a little tax advantage to that. It just depends, right? Could be. So we're going to see an owner's salary on here is what we're saying on the profit and loss. We're also going to see a draw on the balance sheet that tells us what's going on. Today's class, understanding financial statement, understanding how money is moving through and what's going on. Okay, what else do you think might be really important that we went through? Yeah, the rent is that's very important, especially in a retail environment. You bet it is. Rent can get really pricey in retail. However, what's the most important thing in retail? Location, location, location. It can be, really, very true. Varies a lot. In Springfield, it varies a lot. I don't know what your average rent is here in Springfield. A good retail business could be expected to pay a minimum of about $16 a square foot.
Most small clients I've worked with, like maybe their shop is literally the size of this room.
Right.
350, 400. I mean.
A month.
So. I don't know what's normal. I just know the companies I work with.
Yeah. Good. Let's talk about rent and how it's figured, because as we talked through that, I said $16 a square foot. If you had 1,000 square feet, rent is always quoted as an annual square footage number. So $16 a square foot at 1,000 square feet means I'm going to pay $16,000 a year. If I divide that by 12, it's $1,333 a month. And then a lot of times leases will add on additional expenses, things called double net, triple net. Double net means you're paying 2 additional items, probably a CAM charge, common area maintenance fee, or the taxes maybe on your part of the building, or the insurance is another thing that a lot of times they will add into a lease payment. So it's always good to read between the lines. I think that's probably the number one need in the beginnings from any type of business for an attorney, is to review that silly lease agreement, because, yes, oh dear, that's okay. We're in the tornado shelter, right? That's probably the number one thing. You know, they bring in a lease like this. You know what? I'm not good enough. You know, I'm not an expert legal advisor, and so there's lots of Oh, Naomi, I'm so sorry you have to get out in this. Oh, wow, good luck, okay. Okay, one thing that I think is important and to always know, is figuring out kind of what's going on in the business is they're extending terms. Okay, so that changes a lot of things. If you're extending terms to your customer, it can, because now you got to track it. So they extend terms to customers, I think is important. What else? They have loans. They have some debt. So we know that they are going to have to figure out how to pay that back. Right? What else?
They'll have utilities too.
Oh yeah, they'll have lots of their operating expenses. But we're going to be, truthfully, the number one expense we're going to be interested in, always we're going to identify the largest expense, and that's where we're going to start. And in this case, it's going to be cost of goods sold. We're not going to be worried so much on an ongoing analysis basis on things that we've contracted, that we know how much it's going to be. We're going to work on controlling the expenses that we can control. And inventory is, of course, one of those things because